We wanted to sum this up and talk about how this actually works. Importantly, as many of you from working with us on oil and gas, Valor doesn't offer oil and gas. There are regulatory reasons why oil and gas is offered through our sister company, Valur Finance. And so I'm going to give you a little preview of that process in a second, but not go too deep into that. It's something that we can definitely talk with you individually about if you or a client wants to get involved. At a high level, the idea here is that we, Valor, and eventually Valur Finance, help by qualifying you or your clients by figuring out if this is going to be something that's going to save you money. If your income is over about $300,000 and you're an accredited investor, you're going to qualify. It's not for everybody, for sure, even at that level, but that's where the numbers tend to point in the right direction. Our Valur Finance's systems will help you understand the optimal size, or rather the biggest project investment that you can justify given your income. If you make $1 million, it's going to tell you that a $400,000 or so investment is probably what's going to yield the maximum tax benefits. Once you have that information, it's up to you to review the available information, pro formas, models, documentation, and then invest. After that, you get that upfront deduction, which you take via a K1. It goes on to your personal tax return. There's no special entity here. And then that income comes in every year after year one.
One thing that I wanted to add here is that the process is the same as Jeff has described. It's just that one piece here is the accredited investor verification. So the requirement here for people to know that they have to be an accredited investor. So either their net worth has to be above $1 million, or if they're married filing jointly, their last year's earned income has to be above 300,000. And that's an important requirement. And there is a third-party verification that you have to perform in the process, get a document from them that says, we certify that you are an accredited investor. You take that, give to the fund. The process is relatively simple. It takes literally 2-3 hours to get that done, but it's good to know that it's a part of the process. You have to be an accredited investor once you have that information. It's simple as that. You give out the documents and you move forward.
That's right. And that, I think, does take us to the last point here. As I said, Farhan and I are not directly affiliated with Valur Finance for reasons that I'm happy to talk to you about if you're interested. But I do want to show you this. And this is something that all of our clients who want to pursue this will eventually head to. This is app.valurfinance.com. And this is a place where we can show you a bit of a case study and also give you a sense of what that process would look like. So anyone who decides to pursue this is going to head over to that Valur Finance site, enter some information, and I'll just click through this really quickly. Let's put in a name. You'll verify that you're an accredited investor, as Farhan said. You'll check a box, but that'll involve an additional step as well. We ask for some information about your net worth, your income. I'll click through here. And let's imagine, for this little just quick case study, let's imagine someone with a $5 million net worth. They've got W-2 income in the range of $1 million. And let's see what this heads to. Put in your address. And this is going to yield. So then it's going to ask you for your risk tolerance, your filing status, and your growth rate. And it's going to suggest the amount of investment that is going to yield the optimal tax benefit given your risk appetite. What you're going to get down below here is a projection of the potential returns. Given that income, given the growth rate, let's put something more like a historical 8%, and given the proposed investment size, down here you're going to see a summary of the potential returns. This suggests that given these numbers, this particular client would see $1.35 million after taxes over 20 years with an oil and gas investment versus about $1.05 million after taxes without an oil and gas investment. We also include here a detailed returns table. Do you maybe want to talk through this table a little bit?
Exactly. In the detailed returns, you're looking at two aspects: depreciation, tax savings, and the estimated oil income. In year one, you're looking at, again, you're putting in $1, you're looking at 92-94 cents in depreciation. We applied your tax rate to get to the savings. The remaining 13-14 cents is coming from year two. So you can see the actual schedule here, how they're coming through and plan accordingly. And then on the other end, you're looking at estimated oil income. Now you're maybe surprised looking at 2025, there is no cash flow, right? And that's where the point comes in. There is no drilling in 25. It's just the fund is open. It closes on December 31st. And then they take everything, issue K1 for the last year, and then they start tracking drilling. So it takes time to identify wells and all those things. So it's not going to be from day one, January 1st, but the cash flow is going to arrive in 26. Now, first couple of years, these are cash flow numbers based on historical returns, right? This is not something definitive. This is based on what we have looked at the historical returns, and we have a slightly conservative approach. But numbers may be slightly aggressive if you go to another source and look at them, but we just tend to have this slightly conservative approach. In year one, in 26, you're looking at a slightly lower cash flow compared to year two. And the reason for that is the cash flow doesn't start from January 1st. It takes time. So suppose if they start drilling in May, June, your first year, it's a quarterly distribution. So they don't have the full year cycle and the first couple of years. So it's lower in 26, and it's because they started drilling later in the year. But then you're looking at 156,000, 176,000. And, if you sum them up, you're looking at a capital return over the course of 4 to 5 years. You see the cash flow goes down because we are assuming that they extract majority amount of oil and gas in first couple of years, and then it started to go down because of the low quantity and the price.
Just importantly, this is not just something that we conjured up out of thin air. This is based on the actual historical returns from the funds that we work with.
These are historical returns, but the trend of year two is it takes time to start drilling. So it's we're not starting on day one, January 1st.
That's right.